Don't say fear. Don't. It's you're still afraid. If you're not afraid, then you're gonna go the high risk route.
Didn't.
It's
No.
terminologies. Trust me. No,
I
no, 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 no,
completely
no, no.
disagree.
It's
I complete This is Nerdy Mondays, and this is your hosts, Kevin and Jai. So, Jai, the reason why I brought all this up was I was watching a couple of YouTube shorts, and there are two things that came up in completely different shorts, but sort of the same thing.
What Trump said at the time was he said, I never want you to forget this. He said, and I want you to hold on to this mentality for as long as you possibly can, because it will always be applicable in the world of business. I said, I'm listening. He said, when you go to a bank and you borrow $3 million and you can't pay it back, you got a problem. He said, but if you go to a bank and you borrow $300 million and you can't pay it back, we've got a problem.
That's right.
He said the moral of the story is the more you get people to invest in you, the more diligently they must work to ensure your success.
And it just kind of got me thinking, like, what? What does that mean?
mm,
So, before I kind of elaborate and tell you what I think, when you hear that sentiment, what do you think, Jai? What's in your mind when you think about that?
based on the comment alone and just me freestyling. In other words, the more money you borrow from the bank, the less it becomes your problem and the more it becomes their problem. So, in other words, if you're going to invest, if you're going to do something and you have to borrow money from the bank, make sure it's in large amounts. Like the more you borrow, the risk gets transferred, the more the risk gets transferred to the bank. That's the way I
Yeah,
understand it.
and yeah, and I guess my other question, follow up to that, why is it that us as, normal people, we're told to not risk, right? Because it sounds to me that's a bigger risk. So basically, the bigger the risk, the greater the reward. But then we're taught to mitigate risk. We're taught to, you know, be risk averse, try to save up your money as opposed to borrow money. What do you think about that? And
Yeah.
I'm just prefacing that with respect to this notion of, like you just said, and I think I agree, the more, if you're going to take a lot of money, if you're going to borrow money, borrow lots of it. But that's counterintuitive to how we are taught, where, risk, mitigate risk, reduce your debt, don't buy on debt. I don't know.
Yeah.
Elaborate,
No, I think it
or
has.
am I talking too
No, no, no. I
much?
think it has a lot to do with collateral too, right? Before a person like whoever it is that you watch, or maybe even Donald Trump can get a collateral from the bank, they have to have something. I mean, not sorry, not collateral. Before they can get money from the bank, they have to have sizable collateral that would match or at the very least match the amount of money that they're borrowing. So in other words, if you and I go to the
Mm-hmm.
bank and ask for $300 million, they're going to laugh at us because they're going to say, "What do you have in assets that can mitigate if you don't pay off this $300 million loan?" Folks like
Mm-hmm.
guy you're watching or Donald Trump have, you know, variety of assets. So Trump would have things like Trump Tower, Mar-a-Lago, like there's so many things he can, put down as collateral. However, I guess what that also speaks to is if you're not able to pay back, how much are you willing to let go of from your perspective? So if you borrow $300 million and you have Mar-a-Lago, is he willing to let go of the $300 million, or does he have other, room to do other stuff? So the bank, it becomes the bank's problem because this guy's not going to pay us this money. We have to sell Mar-a-Lago. So what are we going to do? You know what I mean? So, and it's becomes less of a burden for him because he's like, well, you take Mar-a-Lago. Maybe he has other assets. So I think when you get to
So,
that level, there's other, your collateral is, it just speaks for you to be able to get more money and you don't care whether or not that you don't care, but I guess the value of you borrowing that amount of money doesn't really matter because at some point, even if you lose it, you have your assets that can cover you. Maybe that's what it is.
so I think that's one. No, and I think that's one way to look at it. This is just, and I hear what you're saying. So if I can kind of reiterate what you're
Sure.
saying, you're basically saying you can borrow the money as long as you have the money to show what you can borrow, right? So
You
like
have the
Trump, he
value of
has
the
a
money to
million, he
show
has,
what you're borrowing. Yes.
yeah, so he has 300, he has a billion in assets. So if he wants to borrow 300 million, then that's all good because they could always take his assets and then they can recoup their losses there. I hear you, but I think that's actually wrong. I think that would work. What I extrapolate from it is that you don't necessarily have to have the money, but you need to be, investing in things that can potentially generate 300 million. So, for example, say you're going to build a building in Dubai and you've already done all the work, you've done the balance sheets, you've done the projections, and you have the seed money, you have potential investors, and so they have maybe 10%. The investors are willing to invest 10% of the overall cost, and then you're looking for the bank to invest the 90%. I think that's what they're talking about. And the reason why that makes sense is because if you look at it from a house, think about it. We only put down 5%. Yeah, why is it the bank is willing to give them a house and they only have to put down 5%? I think that's the logic. I think that's the key. And this is one of our problems where we look at money and we look at the bank as something where we need to fear. But I remember one time a friend of mine, he said, if you have good credit, they fear you. Like you are the one that has all the keys. You should go to them and say, "What do you have to offer me? I'm going to use this credit card for the next 3 months as my main source for spending. What can you do for me? What can you do for me with respect to this card?" And we don't do that a lot because we're in this matrix of always thinking we're begging money and they're doing us a favor.
Okay.
So I kind of look at it like from that perspective.
Fair enough, but it's still the same concept though, because you can't go to the bank even for the person that's going to buy the home at 5%. The home is your collateral. It's the same concept. A bank's not going to give you money if they don't have anything to take from you if you can't pay back. So I get the concept of it's
But,
our problem versus your
mhm.
problem when you bought a smaller amount. But the larger you borrow, the more the collateral and the more maybe even people are involved as opposed to just you as an
Y-
individual, because that example you gave involves investors, right? So you're sharing the risk. So there's no
But the point
point.
is, it's only 10%. It's only
That's
10%. And just
fine.
like when you buy the property, it's
But
5%.
remember, they have to value your assets compared to what you're borrowing. At no point will the bank give you a loan that's than what the value of your asset is. So your house, if you're going to borrow 300 million, your assets can't be less than 300 million. If Because if they have to come after
No,
you,
not necessarily. Not necessarily. And here's why.
okay.
You buy a
Hmm.
house in the year 2019,
Hmm.
the market
Hmm.
crashed and the market went down.
No, as at the
So you bought that
time,
house in
as at
2019.
the time they're
Yeah.
assessing your loan, the value of the
Okay.
loan has to be equal to, or at least your value asset has to be at least equal or more than what they're giving to you. So yes, the market could crash, of course, and your value of your assets could go
Hmm.
down. But at the time they're giving you the loan, it has to match or at least be significantly more than what they're borrowing you, or else they won't give you the loan. That's just how
Yeah.
they operate.
Yeah. But don't you think from the 5% of that's, the young family that just got out of university, don't even have a job really, and as long as you put down 5%, you can buy that house? Don't you think it's exactly the same as say you getting investors at 10% of an investment? A real estate deal
Hmm.
that's happening in Dubai or
Hmm.
something, you have investors. Don't you see that's the exact same thing?
Sort
Or you're,
of, sort
or
of.
you
The
don't?
the only difference, I don't see it as the exact same thing because in one situation you're carrying a lot of the risk. I mean, you're the sole carrier of the risk as opposed to you're sharing the risk amongst investors, which is what smart business people do is, like developers or builders. They're not going to use their money. They're going to use
Hmm.
your money because it's everybody that's, they're sharing that investment risk, right? And if something happens, guess what?
Well, sorry, just to clarify, in Toronto at least, builders are not allowed to use your money.
Yes,
They
yes, but
used
for
to
the
do
most
it.
part,
They're not
yes.
allowed. So your money's in escrow, and then once again, they take out a loan. They get a loan from the bank
Again,
based
assets,
off of
the
the
value. Yeah,
sales.
exactly. So,
Yeah.
but what I'm trying to get in essence here is that they typically don't use their money. They use
Yeah.
collateral and then money from the bank. It's an if you have to
Hmm.
pull in investors, you're using their money and collateral from the bank, depending on how you split it. And that may be 1090, 2080, whatever the case may be. What
Hmm.
I'm trying to
So why don't we do?
go ahead.
Yeah, go
No, no,
on.
go ahead. Ask your
Just
question.
gonna say so now that we know, and now that I think we kind of aligned where we can see everyone buys a house at 5% down. I did it,
Mm.
even, first time home buyer. I took advantage of it. Why do we stop there? If we know that the same recipe works, why do we stop there? Why don't more people buy
I
franchises,
think it's
right?
more about risk tolerance.
Buy a
Yes,
franchise.
risk tolerance and
But
cap and
but
hold
it's
on,
not
hold
it's
on.
there's no
There is it's risk
sorry.
tolerance because remember when you go
I
into
think it's fear.
well, that's
I think
risk
it's fear.
tolerance because that's why they
Is it
evaluate.
really?
Yes, of course. If you go into
So you're equating risk with
it
fear?
is
That's interesting.
technically
I
it
don't
is
know. I never
because
really thought about it.
okay, say for instance you walk into a financial advisor, they're gonna do your KYC, know your clients, and they're gonna assess you based on what level of risk tolerance you are, high, medium, or low.
Yeah.
Most times if you're talking about a person who's just comfortable with, I'm just going to put down 5%, I don't want any hassle, I just don't, I don't want to invest in any franchise, they're going to assess what does that tell you about that individual? They're not, well, they are afraid. That's a low risk. That's low risk as opposed to someone who might say, okay, well, I want to do a franchise, but I want to partner with somebody that's medium risk. Someone who says, "Yeah, I'll do the
Hmm.
franchise on my own. I don't care." That's high risk. It's the same equation. It's just different terminologies. I remember I worked in the financial sector, so it's when you look at when you equate it, it's like, okay, what's the risk tolerance? Well, how much risk is this person willing to take? How much how scared is
You
this
know,
person to take on?
one thing I realize in all of my decisions, I mean, I guess I kind of learned or I was told, you need to take emotion out of business
Hmm.
decisions, things that are like this. And so when you talk about fear, that is an emotion. And so I think that's part and parcel of the problem. There is risk. There's risk inherent in every decision that you make when it comes to money. Just buying a house, the location, investing in a certain stock. There's all going to be inherent risks, and the greater the risk, the greater the reward. That's the old
Hmm.
saying. But the trick is that when you're equating risk associated with a fear, I think that might be a bigger problem too. Maybe this is a big problem with people that don't necessarily come from, big money and, oil money, things like that. Risk should, at least in my perspective, in my mind, risk should not be associated with fear.
It
It
shouldn't.
really
It
shouldn't be
shouldn't.
because if you run
Yeah.
if you run the course that way, then at the end of the day, it's no greater than you thinking like gambling and luck. Because okay, I got lucky, and if you just took this one chance and fear got the better of you, or you got the best of the fear, if it's successful, it's going to be no more than you going to the casino. You got lucky. This is a problem. Risk should not be associated with fear. I don't think
Well,
at all. I think
here's
risk is something that is calculated.
that's the
You
difference.
take a look.
That's the
There's a
difference.
level.
Yeah.
There's a
Yeah.
gradient. There's a gradient. There's an association to it. Like there's certain vehicles of investments where you need to have at least $50,000,
Hmm.
at least $20,000.
Hmm.
That's it. You got that money, great. You're now welcome, right? Even my wealth simple. Only when I put over 100,000, that's when I was invited to do private equity.
Hmm.
Under that, I didn't invite me to do private equity. So the trick is that that's not really a risk thing, but the point of the matter is that these things are all just decisions. It's not risk. It's not fear. I'm not
Hmm.
worried about whether my money is going to come or go.
Hmm.
I look at it like this is a calculation that I'm doing based off of my current age, how old I am, how much time I got left, and really that's it. And then obviously inflation and things like that. but I'll let you speak.
Okay. You talk about gambling, you talk about risk, and you talk about fear. Everything
I know
is
I talked a lot.
no, no,
Sorry.
that's fine. But in my mind, you see, everything is all they're all in the same. There's a thin line amongst all those three things, and they can be interchangeable. The only difference is,
But there's a thin line between love and hate too.
yeah, but the only difference is calculation that how much how well educated you are when you're taking those and making those decisions. So when you go to a financial advisor, there's that okay, do you have 50 grand that you want to put in a mutual fund, or you want to put in a high risk yield, or you want to your emotion is going to take into effect how you make that decision at that point. I understand is it's all semantics. Okay, don't say fear. Don't. It's you're still afraid. If you're not afraid, then you're gonna go the high risk route.
Didn't.
It's
No.
terminologies. Trust me. No,
I
no, 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 no,
completely
no, no.
disagree.
It's
I complete
you
No,
know
so
what?
hold up.
Go ahead.
I hear what you're saying, and don't get me wrong.
Hmm.
I too have fear,
Hmm.
but what I'm just trying to say is to just it's sort of like your son, right? Our
Hmm.
sons, they're afraid of falling.
Hmm.
But we know falling is a part of life.
Hmm.
We're not going to protect them. We're not going to do them any we're not going to help them if we just keep protecting them. They have to fall. But that is a part of life, and that grows you.
Hmm.
And so what I'm just trying to say is fear and like money should not be anything that's related to fear. It should just simply be no different than when you're making a decision. Do I wear a blue shirt or a red shirt? Is there a specific reason for this blue shirt? Okay, then, okay, you know what? Maybe it's St. Patty's Day. Maybe I'll wear green. That's how we should be making our business decisions. It's a business. With what's happening in the world with tariffs and Trump and all this stuff, you being on the sidelines is not even an option anymore. You are losing every second of the day. You're losing money as you sit on the upside on the sidelines waiting in fear of something. That's absolutely asinine. At the end of the day, when you have the resources, you deal with it. Just like how when you graduate, you just find a job. There's no fear of that. There's no if should I.
But you
You
take
have a
hold on.
profession now, you
Okay.
got a job.
Let me sorry, let me budge in. I let you speak. But here's the
Please,
thing.
please,
All these
please.
things you're saying is you go to university, you have a job, you do that. You're taking a chance. You're overcoming your fears because you want to become something. You're taking a risk. You don't know that that
You were
job.
afraid to go to
No, no, no.
university?
I'm not saying that. Hold on, let me land. You just rambled on for like 2 minutes. I didn't interject. What I'm trying to say in essence
Sorry,
is,
sorry.
no, it's all good. What I'm trying to say in essence is all of these definitions are semantics. The only difference is the level of, like, for risk as an example, it's calculated. But there's still some element of fear in it because if you didn't have any fear, everyone would just be high risk. They would just rate them as high risk. That's why when you go into an investment
I don't
banking
think so.
office, okay, when you go into an investment banking office or financial
Real quickly,
advisor,
sorry, real quickly,
sure, go
brother.
ahead.
You're 6 foot. There are certain things that you have that I don't have.
Mhm,
I'm 5'10".
mhm,
I'm 5'10", or almost, yeah, 5'10".
mhm.
There's certain functions that there's certain ways that people look at you different than me. It is what it is. So when you talked about risk in that way, no, you make a certain amount of money. You are limited by this type of money you make. And if you want to get into the upper echelon, you got to earn more or let your investments grow and then your portfolio grows.
But there's
Just wanted to say
always,
that.
yeah, but there's a reason why when you walk into a financial advisor, they rate you based on your risk level. I don't know if you ever done a KYC or know your client assessment. These are some of the questions that
Hmm.
they ask you because they want to be able to rate you and provide to you the best form of investment based on your level of risk tolerance. Risk tolerance is okay,
Or
is maybe how much,
that's when you go to the banks.
uh-huh.
Sorry, that's when you go to the banks and the banks will only be able to sell you products that they are allowed to sell you.
But that's different though.
That's the one
But that's
thing.
different because we're
That's
talking
but
about if
it's
you're going to
it
invest.
how's it?
Because if you're going to invest, okay, let's break it down. The argument is my argument is that a
Mhm.
lot of times when people quantify risk, it's almost pretty much the same thing as how much fear you have with regards to investing or putting your money to do certain things. So it's
Hmm.
your level of exposure to uncertainty or how much you're willing to lose. A calculated risk is basically your exposure to that uncertainty and how much you're willing to lose by fully understanding or at least managing what it is, or you can control what you're willing to lose. So when you have high risk, you're willing to let go of a certain amount of money because you know that, guess what? If I can let go of this amount of money, I can either make this or lose it. And I'm okay with that. I can live with that. But if you're fearful and you're low risk, you're going to say, well, you know what? I have 50K. I'm okay with just investing 10K and leaving the 40K to sit in the bank. That's the difference. So I get it. You might not
But
like
that's
the words, but they're kind of, they're interchangeable in some way, shape, or form. That's
I
why the term know your clients is very important because they need to know what your level of risk tolerance is.
and I hear you. I was just thinking. I was just looking at the lens with respect to the know your client comment, at the lens of the banks are always going to be able to give you their products
Mhm.
versus if you go with a broker, they are not tied to any bank. So they'll be able to give you products across all facets. So not just banks, but insurance companies, things like that. So that's all I was just trying to say. Though, but I hear what you're saying with respect to the risk tolerance. But the last statement that you said, I don't agree that that's fear. That's
It is.
calculating,
It is
and
because
it's not. Hold
no,
up.
no, no. Hold on.
So
Let
you
me
have
before you finish. I'll just say this last thing. My apologies.
okay.
They,
No, it's all good. I cut
by
you off.
law, the fintech, I can't remember what the body is in Canada. By law, you have to do your KYC. Why do you think they do that?
Hmm.
Before you introduce a client to certain investment or before you give them financial advice, you have to do a KYC. Why do you think they do that? Why do you think that's mandated?
Okay. The reason why I laugh at that is because once again, I don't know how you got to your millions. I'll tell you real quickly how I got to my millions. I had a house, I was consulting, my accountant was doing what she's supposed to do. 1 year, I only paid like $9,000 in taxes, right? But my income only showed I made $10,000. So I tried to buy a second house. They did their fiduciary responsibility analysis of me, and they're like, based off of your income, no, right? Based off of this and that and all these calculations, your loan to debt ratios, you cannot afford another house. But I'm like, okay, but I want another house and I'm self-employed. I'm pretty sure I can handle it. But they're like, nope, I'm taking the numbers, I can't. So what did I do? I rented out my property, showed that this property can now earn its own and make its own money based off of the rental, the area, the volume, the demand in the area for renting. So once that happened, the banks were like, okay, all right, well, we'll take that off your plate then because it's going to pay for itself. And so I took equity out, saved up money, moved back home, and then saved up money, and then I was able to put down a sizable down payment. My point, what I'm trying to say is their risk assessment did not tell me to do that. Their risk assessment only told me what it is in my current state. They did not tell me, okay, here's a trick, here's a way that you can do this,
But
right?
that's different
That's my
though. That's
problem.
it.
That's
No,
my
no, no. But
challenge.
you're conflating
I
two
hold
things.
up.
You're
You're
conflating two
you're
things though.
you're not you're not wrong that it's different, but see the trick though is that people listening to this will only look at it like, okay, whatever the bank says with respect to this KYC thing, this is my limit. No, that's not accurate. That's all I'm saying. It's not accurate. So when you live by fear, you're gonna die by fear.
Oh,
The
but
point what I'm trying to
that's
say
not the
is
argument,
take hold
Kevin.
up, take all
That's
take all your
that's
take
not the argument.
how is it not the
It's
argument?
not the argument. I'm not saying, of course,
But
like I understand
your
that
premise
from a
your
financial
premise though,
perspective.
correct me
No,
if I'm wrong.
yeah, go ahead.
Jai, correct me if I'm wrong. Your premise is at the end of the day, they have fiduciary responsibilities. They got to do your know your assessment and things like that. But ultimately, what you're saying is these are all decisions that you make, getting all this information, and then coupled with your risk and your fear of what you're not willing to lose or whatever, you're going to make a decision based off of that. Is that not right? What
No,
you kind of were
I'm
trying?
saying
Okay, my apologies. Please elaborate.
everybody's risk tolerance is different. you're going from the perspective, and this is how you need to open the box and not look at it from your own lens. Not everybody is going to
Hmm.
make the decision that you're making. Some people have a hundred
I agree.
grand and they want to keep that 100 grand to be in the bank. They don't want to see it diminish, but they don't know that they're doing themselves a disservice. There's people like that. But what I'm trying to tell
Exactly.
you is that you can't look at it from your own
But
lens. You can give advice from your own lens to say, yes, if you do take high risk, there's high rewards. But not everybody thinks like that. That's my point. The point is, that's why they assess you when you go to the bank or to a financial advisor to know how to table your investment or your money. Because not everybody can take or make high risk decisions like you or myself. That's why they do
but
the
let's take your
KYC.
example. Okay, let's take your example real quickly. The 100,000. Not every. I'm gonna repeat because you basically said not everyone wants to take that 100,000 and risk it. They want to keep the 100,000 in the bank. Correct? That's basically what you said,
Yep.
right? Okay. The reality there is I'm looking at it at the lens and I'm thinking everyone should look at this because everyone has to deal with inflation. Whether you like it or not, that 100,000, given the inflation of 3.5%
But
every
that's not
year,
the
that
argument, Kevin. You're
100,000 is
missing the point. I'm not
I'm
disagreeing
just
with
but
you.
let me finish.
No,
Let me
because
finish my
you're
point.
conflating the argument, and I'm not gonna let you
Simply let me
finish
finish
because I'm not saying you're wrong for saying that if you have 100 grand, don't
uh,
invest it. I'm not giving advice to say. I'm just
yeah.
trying to tell you the different levels of people that do
And I'm not
exist.
saying to do all that. I
Okay,
know.
okay. So what are you saying?
I know what you're saying. I'm just saying at the end of the day there's a perception and there's a reality. I'm more of a pragmatist where I think a lot of people don't think that way because of the fear and lack of knowledge. That's all I'm saying. And my in my world, and I think you'll agree, ignorance is no excuse for anything. Just being honest.
Hmm.
And so when people have fear, I feel a lot of times they allow for ignorance to set in. I don't like money. I don't want to think about money. Money's evil. I'm a Christian and money should, I'm just, this is my problem. So I hear what you're saying. I don't expect everyone to do and act how I act, but there are fundamental realities. Everybody knows you cannot walk outside buck naked. Can you? Of course you could if you wanted to, but you know that we live in a society and there's certain fundamental things that will might get you in trouble. I look at it like that. I look at it like you need to understand that inflation is a real thing. It exists. It is not going away. So if you think that $100,000 just sitting there is fine, you're dead wrong. There's no place on this earth where that is fine. Now, if you understand that and you don't care, that's a different situation. But my challenge is that a lot of times people let fear and they use fear as a scapegoat to not do the investment or sorry, not do the learning, not do the education, and not take the time and focus on their reality TV show as opposed to picking up a damn book and just looking at this. I know it's not easy, but at the end of the day, you work hard for this, you compromise your time for that money, you should want to leverage it as much as possible. But I digress.
I still maintain my stance on what we're saying because I think we're going into different dimensions. My argument is not the advice of investing your money. I think if you have 100 grand in your account and you don't invest it wisely, I think you're very silly. My argument is whether you're medium, high, or low risk, you don't leave 100 grand in your account. But I also understand that there's people who will not take that 100 grand and invest all of it. For some people, that would be a foolish decision. That's their fear. And you can't hate them for that, or you can't love them for that either. But you have to tolerate them for it because they're willing to take 30 grand, 40 grand, 50 grand. That's okay. As long as you're investing your money. And I think that's the message we should give to people is don't let your money just sit there because it's not going to work for you. But it's okay to be low risk. You can get to that point where you're medium risk and high risk. It's okay to have some level of fear, but don't let your fear overtake making your decisions, is what I'm trying to say. And this is why I'll go back to it again. Walk into a financial advisor, they will always do your KYC by law. There's a reason for that because they know not everybody has that level of risk tolerance like you or I. So enforcing people to say, okay, you have 100 grand, you have to invest all that money. That's a crime because guess what? You're letting somebody go into something knowing fully well that they're scared to invest all that money. What happens if they lose it? There's a financial crisis. Some people will commit suicide because they don't know that they're going to get their money back. So, what do you have to prove that you talk to that person before making that big decision? So, it's still a level of fear. I know you're like it's hard to tune your mind to it because you're more of a high risk person. But I've worked in industries where I
I'm
see
not.
people have the fears, and it's okay. They gradually move to a level of medium and high. However, they have to start from somewhere. That's all I'm saying.
Guys, like, subscribe.
Yes,
Please like, subscribe if you're interested in the discussion. I hear what you're saying. I think definitely we will agree to disagree on that. Bifurcation of fear and risk are two, they shouldn't even be in the same neighborhood.
they
I
are.
think at the end of the day, risk is, well, fair enough. And in the comments, guys, please let me know, right?
Yeah,
Please let us know, right? Because I think at the end of the day, did you feared getting married, you feared buying a car, you feared, but the point is a lot of people end up doing these things,
because you're taking the
right?
risk.
We fear on we But the point, what I'm trying to say is those fears were less relating to, oh my, and less relating to where they're debilitating you from actually doing it. That's what I'm trying to say, right? And so a lot of times I feel a lot of people don't do these types of risks because they're focused on fear of the unknown. And so the point is you're fearful of driving. At one point you're fearful of this and that. But the point is everyone else did it, and you saw it, and so you just realize, okay, this is a part of life. So I guess the next question I have then, maybe this is one of our challenges, birds of a feather, right? I never came from old money. I never came from an investment household. Do you think the investment household would look at risk in a fear based or look at risk differently, or it's all the same across the board?
I think that if you come from a family that's used to taking risks, you're definitely more risk tolerant. So
Mm.
with families like, I mean, the only example we talked about today, the Trump family, I mean, he's one who takes risks because he borrows a lot of money from banks, not,
Yeah.
too scared. I don't think his children would be scared of that or to do that because they know that, well, this is a blueprint that my father has laid. They know how to run the ropes on that. And they will most likely do that. But children like, I mean, myself, I didn't grow up with family that loaned $300 million from the bank. I had to get myself to that point where I understood that, okay, there's ways you can gradually move to a point where you take calculated risks. But there are exceptions, but exceptions don't make the rule. So there's people who, from the bat, they're high risk takers. They have $100, they're gonna invest that $100 and they don't care if they lose it or make it. That's, that some people are built like that. But to your question, short answer, absolutely. Your background absolutely
Hmm.
matters in how you take risks or how you face your fears.
Yeah, and I kind of agree, but I was, again, a little bit different perspective. I think people that grow up with money, old money, they really know how money works versus us. We're kind of in a matrix. We don't really understand how money works. And I think we just follow and pedal to what the KYC, what's it called?
Know your client.
That you said yeah, based off of those things. And I think those are ways that limit us. But I think people that come from real money, they know that they really know how it works. They know how fiat currency works. They know how,
But it's yeah,
foreign,
it's funny you say that though because
foreign.
even
Go on.
you look at if you look at the portfolio for most of these people from old money and when you look at their KYCs, they're all majority of the time they fall in the high risk category. There's a reason for that
Hmm.
because they're used to allowing their money make money for them. They know how to make money. People who are in the medium low risk, especially the low risk, is people who just came into money or people who don't understand how money can make money for you or are scared of losing their money. People who are in the high risk usually come from old money. I'm not saying all the time, but majority of the times.
Let me give you an analogy. So, and again, and I want to make it clear, I'm not a high risk taker. I'm just I'm just
I
making an
bet you
argument, brother.
if you
So
did your KYC, they would rate you the high risk.
no, well, I'm saying high, high. I'm not high, high. I'd probably be like 7 or 8, right? Out
That's
of
high.
10, right? Okay. That's why I said high, high. Anyways.
I know. Go
I
ahead.
figured high, high would be 9 and
Go
10.
ahead. Go
Anyways,
ahead. Yeah.
you know what it reminds me of? And I'm susceptible to this as well, right? We have subscriptions, right? And the subscription, you could either do monthly or you could do yearly. You do the yearly, it's 40% cheaper, but then you got to pay a whole bunch of money up front. Versus a subscription, you're paying so much more, 40% more. Yet we're more tolerant of that. Why? Because the thought of us knowing we can get out when we want to get out, that gives us a sense of peace. But the reality is that we're spending more money than we have to. And once again, I hate to say it, when I look at the banks and their products and the KYC, that's all they're treating us as. They're just deciding whether we can do the subscription or the monthly. And at the end of the day, that's versus someone that's really in this world, like someone that really understands money. It's not even about that.
Yep.
It's all about taking a loan and getting a loan and ensuring that you have some sort of investment or some sort of backing to show the banks that this is worthy and it can work. Like I said, I rented out my property, right? It's a very simple thing to do. All I had to do is show one, I think, yeah, I just had to show one lease contract. This one, so the lady only lived there for 1 month. So I only had like 2,500 bucks in my account from her rent. But as long as I showed them a contract, for 12 months, they're like, okay, good, here you go, right? So that's what I look at it. I just think that's how we are kind of in the matrix.
Mhm.
We think this protection of being able to pull out when we want, but that's where, yes, low risk, but you're not getting anything out of that, right? And one last thing I was just gonna say with the 100,000, what I'm trying to say is take whatever you're comfortable with. So if you have 100,000 and you need to get at least 500 bucks a month, all right. So you take 10% high risk, 20% medium risk, and then the rest,
That's what they do.
low risk, a bond or something.
Yep.
So so what I'm just trying to say though is that you don't need a bank to tell you to do that. That's all I'm just
It's
trying to
not necessarily a
say.
bank, but here's the thing though.
But you
Financial
get what I'm
literacy.
trying to
Yeah, of
say,
course, I
right?
agree with you. No. Don't get me
Okay,
wrong.
thank you.
Financial literacy is something that's huge because, like you were saying, if you have 100 grand, I would rather you diversify your portfolio. If you want to go into financial institution or a bank or whoever it is, and you want them to help you invest your money, you have to understand that they don't do it for free as well. They're going to take money from you. The only institution that
And
does
they
it for
have their
free,
own
and the
agenda.
only exactly the only institution that does it for free is maybe the Wealth Simple, where you can put in your money. But even the Wealth Simple will still qualify you whether
They
you're
have their agenda.
yeah, they'll still qualify you as whether you're high,
Okay.
medium, or low as well before they start investing. Because if you look at your portfolio, you're going to see which yields are in high, which yields are in medium, which yields are in low risk. But I think as individuals, the advice should be given to people is always diversify your portfolio. Don't put all your eggs in one basket. There's a reason why they say that. So that 100 grand, maybe 30 grand you can invest in mutual funds or whatever the case may be. Maybe you can use 20 grand to buy property at 5%. The other 20 grand you can buy gold or insurance products, whatever the case may be. The whole point is at the end of the day, I think the best thing you can do is to diversify your portfolio. That's my advice.
What about cryptocurrency? What are your
Yeah, it's
thoughts on
part of your
that?
diversifying your portfolio as well. Like I have a little bit in crypto, but I wouldn't put the whole 100 grand in crypto, if you know what I mean. Like that's,
Yeah,
I think that's people swear by
exactly.
crypto. People have made money through crypto, but again, it's something I'm not. I'm familiar with it, and I understand the concept. I get the whole blockchain technology. However, having said that, I think there's a lot of meme coins that come out that you don't know the legitimacy of these coins. Some of them have come out and gone under. I think the only big ones are Bitcoin, Ethereum, and you can do your research on those. But I would say I wouldn't put I personally would not put all my money in crypto. Put a little bit of it.
Do you know exactly what, yeah, do you know exactly what cryptocurrency is?
Yeah, it's just blockchain technology for the most part. At least that's the way I understand it.
Yeah, I'm just reading it from ChatGPT. So
Okay.
cryptocurrency is a type of digital virtual money that uses cryptography for security. Unlike traditional currencies like the US dollar, Canadian dollar, cryptocurrencies are decentralized,
Yes.
meaning they are not controlled by
By
a
the
government or a
yes.
bank.
So in other
Yeah, and
words,
when you mentioned,
that's why a lot of these are using the
sorry,
dark web, like by criminals, enterprises, and stuff like that, because they can't trace the source. It's basically like saying
yeah.
everybody in that chain has to agree that you have something. And then basically when they all agree, it's like, okay, well, that's part of the blockchain technology. It's a whole convoluted explanation, but I think what Kevin read from
Hmm.
ChatGPT is a very simple explanation of what it is. It's a decentralized way of having money as opposed to the bank. It's regulated because you and I have cash, and the bank knows who owns it and when they can regulate how we spend it or how we use it and the currency. But with crypto, it's like nobody regulates it. There's no central bank.
Yeah. And you mentioned blockchain. So blockchain is a technology that runs on top, that cryptocurrency or Bitcoin, if we're talking about just a specific cryptocurrency, Bitcoin runs on. So it's a blockchain, and most currencies run on blockchain, which is a public digital ledger that records all transactions transparently and securely. And there's something called immutable. Basically, what immutable means is that it cannot be changed at all. And so that's why the blockchain and Bitcoin is so trusted, because that hash, whenever you make a transaction, is cannot be
It can't
changed
be
at
changed.
all.
Yeah,
So yeah, and it's so serious that, let's say for example, you had a digital wallet and you had your password, and if you lose that
that's
wallet,
it.
your money and everything
It's
is
gone.
gone for indefinitely.
It's
There's
gone.
no way to
There's no way
actually
to
get it
retrieve
back.
it. Yeah, that's
Yeah,
the
yeah,
danger of it. That's why a lot
yeah.
of people.
Actually, one thing.
Yeah, go. Sorry, go ahead.
Also, so no, no, no. You were gonna say
No, no, no.
something
I was
interesting
just
here.
saying that's why a lot of people store their keys or their passwords in very secure vaults because once you lose it,
Exactly.
that's it. But go ahead.
Yeah. I think I said it on another podcast, but I actually just started. Well, actually, it's been a couple of months, but every day I buy $30 worth of crypto.
That's pretty good.
Like every day.
That's pretty good.
Yeah, every day.
Yeah, that's very good.
I just figured, yeah, I just figured, you know what? I don't think Bitcoin is gonna die anytime soon, and $30. I figured spend it on
Frivolous
crap,
things.
so why not
Might
just
as well. No,
maybe just
that's.
put it towards something that might grow,
I
right?
might borrow that idea actually. That's not a bad idea because if you
Yeah, and the reason why I did it is because, again, this is again part why I got a little triggered is it's hard looking at your numbers. It's hard watching. Look, ever since Trump came into office, I have been dreading looking at my Wealth Simple. I've seen it go from 130 all the way down to 109. Like this, it's scary stuff, guys. But the trick though is you have to be on top of it. You cannot let fear psych you into not looking at things and keeping on top of things. And that's just my passion, right?
yeah
So I apologize if I triggered anyone or if I caused an argument. It's just I think fear is part and parcel of why sometimes we just don't do things or in action, and we need to be active. We're active in our time, and time is a direct correlation to our money. So I don't want to waste my time. I don't want to waste my money. But one thing I was going to add is the reason why I did the Bitcoin is because I preface all this because I go into Wealth Simple all the time, even when it was down to 109,000, down from 130,000, right? It's painful. But what I was looking at is I'm separating the noise and I'm looking at the signals. And what I've noticed is, yes, Bitcoin will drop drastically, but overall, it's still, it's the one that I see going up plus 145%. The Tesla and things like that, they're going great. Sometimes I'll see 30%, average yield of 30%, 40%, which is fantastic. But I haven't seen, at least in my portfolio, things that are like 100, 200%, like Bitcoin. So I just figured, you know what, why not? It's $30 a day, and we'll see how this works out. But the point of what I'm trying to say is, I'm not letting my emotions drive me. I'm just simply looking at it for what it is. That's it. Money is just a tool. Do I worry about a hammer? Do I decide which hammer to buy? If I was a contractor and I was in my field, then yeah, a Milwaukee hammer versus a whatever hammer, you know what I mean? Another brand hammer. They may say like, "Oh yeah, you know what? I know these type of hammers. This is my fresh." But the average person is not that. And when you go to the store, you just buy a hammer. That's it. You don't think anything of it. So I say, look at your money that way too. I'm not saying to throw it away, but I'm just saying if you need to make a decision, make an educated decision, right? Any thoughts on that, or are you
No,
going to completely disagree on that as well?
no,
I'm just joking.
I didn't disagree. I think it was just
I know I'm playing with you.
the what they call it. But yeah, I mean, I think what you're saying is true. Diversifying your portfolio is key, and I like the idea of that $30 a day. I think I'm gonna maybe not $30, but whatever loose amount of change I have, I'll just spend on it every day. Goes a long way. And what I found is, and this was just my observation, and again, you can correct me if I'm wrong or fact check me, but a lot of times when I've looked at my portfolio, when I see that other stocks or mutual funds are going down, crypto is usually very high, right? And
Mm.
then it's the opposite when crypto goes down. So it's like just to balance your portfolio, have something, have crypto, have other stuff, buy gold, whatever the case may be. That's if you're going the investment route, of course. Like we talked about, there's also real estate and there's other things that you can also diversify and buy. But diversify your portfolio. Don't keep all your eggs in one basket, and don't let fear drive you. But it's okay to have a level of fear and tolerance for what you're doing. Just don't let that dictate how you make your financial decisions, because leaving your money in the bank is dangerous. It's not going to yield anything.
Educated risks as opposed to uneducated risks.
Correct.
100% agree. Funny story. I tried to take out 50,000 out of the bank, I think maybe last year sometime. Let me tell you, it was so annoying. I asked for the money and they said come back in 2 days. Came back in 2 days. The manager was like, "Oh, no one told me. Can you come back in another 2 days?" I forgot, and I got busy, and so I came back 4 days later. So not 2 days, 4 days later. I'm like, "Okay, where's my money?" And they're like, "Oh, well, you're supposed to be here 2 days ago." I'm like, "So it's my money." But they're like, "Well, yeah, we don't keep it around
No,
like
they
that,
don't.
so you didn't pick it up, so we put it back."
Yeah.
All this to say, don't is that not scary? It's my money, and I have to go through hoops to get my money.
Yeah.
Because last time I checked, you don't go through hoops to take it from me, yet I have to go through hoops to get it. Long story short, I gave up.
That's why
I
people.
gave up.
That's why people
But
go
I
to
gave
crypto.
up.
That's why people use
Yeah,
Bitcoin. But that's for one of those reasons,
exactly.
especially. But go ahead. Yeah.
But here's why I gave up. I actually just gave up for me, and here's the reason. I was initially gonna take out 50 Canadian. Then I was thinking, there's an apocalypse. Would U.S. money, would Canadian money be useful? So then I was like, you know what? Maybe I should take out U.S. And then I couldn't decide, and so I just said, okay, you know what? Forget it. Let's leave it at the bank.
If
And then I think there's also a
there was an apocalypse,
tax implication
yeah,
too.
to take out money, I don't think so. Is there really? I didn't know that.
I thought there was, yes, I think,
Was it?
anyways,
Were you
because
taking
I have a
out from your
corporation.
like? Oh, okay, okay, yeah,
I have
okay.
a
See what
corporation.
you're saying.
Yeah, yeah.
Yeah,
So
probably. But I mean, if there was an
don't,
apocalypse.
guys, don't tell the CRA this story, please. I might get in trouble. Well, I never took out the money, so either
Okay.
way. Go on.
If there's an
You're talking about an
apocalypse, I'm
apocalypse?
saying I think gold would be the best thing because currency becomes useless.
So, you know what? That's the other part. I was also thinking about too. And so I was like, okay, you know what? Let's look for a place that provides gold bullion. So you can invest and you can buy gold, but you'll never be able to touch it. So I was looking for a company that actually
No.
sent me the bars.
Yeah, Costco could do that.
Oh, really?
Hmm.
So if but wait, you're talking about buying it off retail, like buying it off the shelf in Costco, or
No,
an
no, no. You
actual
go online.
place that specializes?
Yeah, you go
Yeah.
online, you register you if you're a Costco member, and you can request to buy, and they'll mail it to you.
Okay. Okay. Well, let's just see if Costco's numbers are competitive to like other people that specialize in this, but I didn't know that. So that's actually, I might actually look into that. One other thing I did was I did buy gold stocks. That's another thing I want to say. So if you do we mentioned this, but in addition to diversifying your money, you also want to diversify your investments like stocks and things like that. So if you buy crypto, I'm not educated, I don't have all the information, but a lot of times there's competing industries. So if you buy oil and you buy gold, what you do, again, I'm just giving you an example. When oil goes down, gold will go up, and then vice versa. So that you had your risks, you had your losses that way. That's a really great way to diversify and things like that. Again, that's the same thing you're doing with your money. You're taking your larger amount of money, you're putting that safely, and then you're investing in the small. And so where the big is slowly growing, you have the small, risky, growing faster. And then when it goes down, because it is risky, you have the middle to potentially offset because that's not as risky. It should still be going up while your risk is going down. And then when things are good, everything's going up at the same time. And then you have your bulk, which is slowly growing. So always think of it like this. If you have an investment, whatever you got to live off, you keep that in the safe space. Not necessarily the banks. Banks don't give you anything. Put it into things like bonds, put it into things that have, very low risk as Jai mentioned. You live off of that, and then the things that are less, the risk and the medium risk, those are things that you're willing to throw away. And I think at the end of the day, that's your best prescription to having a financially secure future. Any thoughts, Jai?
Nope, I agree. But I was gonna throw the question out to folks before we leave. So, what's the difference between, let's assume person A is has 20 grand and they're into sports betting and they have inside information that team A is playing team B and they know that the key players for team A have injuries that won't allow them to
And this
play.
isn't public knowledge,
This no, it's just what they call it,
insider
insider
information.
information.
Okay.
And they have that first-hand information because the professionals that doing this, they always pay people to let them know what's going on in the locker room. So they have all the inside details. And then they put that 20 grand in bet and say, okay, you know what? Team B is going to beat Team A because, I have that inside information. Would you call that a calculated gambling, or would you call that just a freelance gambling? Would you say that was a calculated risk that they took in betting that Team B would beat Team A, knowing that Team A is a better team, but Team A's players are all injured, or most of the players are injured, and you know Team B is fine, and they had inside information that Team A, they had that inside information. Would you say that's a calculated risk, or would you say that's just them gambling?
I'd say it's more than a calculated risk.
Okay,
You're taking advantage of the fact that you have information that other people don't.
okay.
And that's how this world
So
is.
take that same 20 grand scenario.
That's actually how the rich get richer.
Okay,
That's how the richer get richer,
take
by the
that
way,
same
yeah.
20 grand scenario, right? And you study a particular stock or mutual fund, and over the course of 10 years, you know that at every within 10 years, every 2 years there's a dip in that stock or that mutual fund. One reason or the other, you're just looking at financial trends. And you make a calculated risk and say, okay, you know what? At the end of, let's just say you look at over a 20-year period, and you know that after 2 years there's a dip, and you say, okay, well, I'm going to buy now because I know 2 years is going to go up. Is that a calculated risk? Or,
So you're saying if you know the trend, you have a 30-year histogram of that stock, then again, it's an educated
educated
decision
decision?
because
Okay.
you have the information. This is factual information. It's not
No,
like some whisper in the locker room where you have insider information. This is factual.
no, but the factual information about the inside information is actually factual because those players are injured. You can verify, you know that they're injured. What I'm trying to draw in the parallels is that both are kind of gambling. It's just you're making educated guesses.
Not really.
Okay. Let the
Because if
audience
you think about
decide.
gamble, well, think about it.
Yeah.
Yeah, no, 100%. Yeah,
All right.
please, guys,
Like
like
and
and
subscribe and
subscribe,
just
please.
tell it.
Yeah, the reason why I don't think it's gambling is because when you roll those dice, you're not in control. You have no control when you roll those dices, right? Unless the dices are corked or there's some sort of insider where you know that there's weighted the dices are weighted in a certain way, and you know there's a probability and statistics are in your favor, then I don't think that is the same thing. I think the problem, all I was saying is when people look at things from a fear-based perspective, it all looks like gambling. And so the problem is you don't want to do it again because you got lucky. I don't think so.
But that's
I
not
think
in
it's
either
not
in
luck.
either situation. It's not luck because luck would be you placing your bets on the fact that Team B is going to beat Team A because you feel that okay today I just want to feel lucky. But if you know that Team A is better than Team B, you have inside information that players are not going to perform at their optimum because they have injuries, the key players, and you know that Team B have no injuries, and you pick that's a calculated guess because you know you
Hmm.
have inside information. Same way you have not necessarily inside information, but you've taken an educated guess based on the trend because you've studied that. So you're taking risks based on information that you have. You're not just making the decision. Me making that decision for the same as the stock would be just me looking at the stock and saying, oh, it's slow today, not knowing any history of the stock and just buying it. That's the same way a guy would just go and play and gamble and just buy something because he has a feeling that this team's going to win. You're trying to get yourself lucky, but that might not be the case. They're both educated guesses. My point is, life, you got to take risks, but there's some level of
I agree on
fear.
that.
Yeah, there's some
I
level of fear that you'll have in taking those risks. I will not be able to gamble because I have the fear of losing my money. I might not be able
Mhm.
to take that calculated risk with the stock that has a 30-year histogram because I have the fear of losing my money. So I don't want to put 20 grand in it, but I can put maybe 5 grand in it. But
I still don't understand where, because you said that those two scenarios were like gambling.
mhm,
I'm still not clear how they're like gambling. I'm still not getting it.
they are because
You
you're
said,
making it. You're throwing your money. You don't know what's gonna happen. In scenario A, what if hypothetically on that same day all the players on team B just happen to get injured? Same with the stock as well. What if after 2 years, this time around, the histogram is wrong? It's not going to yield in 2 years. It's going to yield after 4 years. What happens?
that's the same thing. You can get hit by a car just walking out of your house. I'm
Anyways,
just saying, like
no,
Jai,
it's
you
not
can
the
apply
same
that
thing.
with anything.
No, you can't.
How is it not the
No, you
same?
can't. You can't apply with everything.
You're not in control of anyone driving on other than you
Same way you're not
yourself
in control
driving.
of when you invest your money. You don't know what's going to yield. Same way you're not in control when you buy property. You don't know if the property values are going to go down because it's going to be a financial crash and housing market's going to crash. Same way. You don't know.
No,
You
you sit
just
here,
it's just you're just making calculated
Jai.
risks and
There's
guesses.
no, there's a over 30 years. We know that 7% houses go up.
Okay?
7%. You're gonna go up and down, but if you look at a histogram and if you cross section it, it's about 70%.
But
Stock, if
you
you
and
invested.
I looking at it that way because
No,
we're
this is facts. This is
but
facts,
but
Jai.
it's facts, yes, but you might have the
Oh my
fact,
God.
but I might not be able to say, oh, you know what? Because there's fact, I'm bold enough to go with that trend. Because maybe when the money's going down, I'm like, oh well, oh my God, my money's going down. I'm not strong enough to wait it out. You see what I'm
No, but if
saying?
you're okay, I hear what you're saying, but I'm just going, just like how I was conflating, you're conflating now.
No, I'm not.
I'm sorry. I'm just here. Yes, it is because again, if you look at the history of a casino, the house always wins.
Why is that?
You'll win sometimes because it's rigged for them. It's
Okay.
their system.
Okay.
And statistically, they make more. That's why they're in business. The same thing with the banks. This is why you don't keep your money in the banks. My point, what I'm trying to say is with the stock market, there is a histogram of 30 years. If you kept your money in the stock market, no matter what stock, as long as it's S&P or whatever index, over 20 years, your money would go up 20%. That's a fact.
But are you
Houses,
gonna put in
7%.
all your money at the same time because you know that it's gonna go up
It's
twenty
not
percent?
it's not about no, it's not about putting all your money. What I'm trying to say is you're equating these things to gambling.
But
Because you
the
said,
reason why I'm equating it to gambling is because people have different levels of fear. The same way you know and I know that 30-year history is safe for you to put your money in stocks is
It's
it's
not just us, it's
beneficial.
public
It is
knowledge.
public knowledge,
Jai,
but
this is
not
public
yeah, but not
knowledge.
everyone is able to take that plunge and put all their money in stocks.
It's not about that. It's not about taking the plunge or taking the risk. I'm just saying it's dangerous for us to tell people that are already fearful
Mhm.
that doing these things are gambling. That's the
No, I'm not saying they're
problem.
gambling. I was
This
just
is
trying
the
to make a
problem.
point. I used that point. I used the gambling to make a point because
I
you
think
brought it
it's a
up.
reckless
You
point.
you brought it up and said
I
that
think that's a
it's
reckless point.
I don't think it's reckless though.
It's a reckless point, man, because I
It's a
think at the
way
end of the
it's a
day,
way.
this is a problem with a lot of people. You've already just admitted
Mhm.
or just kind of defended the people that are fear mongers, right? I'm pushing against that, and I'm pretty sure the average person is a fear monger.
Yeah, but
And for you to now
I think
equate
okay.
making calculated risks with gambling,
I'm not equating.
Jai,
I'm just
you're
trying to drive a point. I'm not equating, and don't get me wrong. I'm just trying to
okay.
drive
My
a
bad.
point.
My
The
bad.
idea I'm trying to say here is this. It's okay, and I think that's what people need to understand because you're looking at it from your lens, and I think that's the danger in society where people give opinions and just give opinions based on their lens and they think that that's the right thing to do. That's not what I'm saying. What I'm trying to say to people is your lens and my lens are not the ultimate. It's not the correct way of looking at things. We might have a difference of opinion on certain things, and it's okay to have some certain level of fears. However, what we agree on is diversifying. But the fact that you don't put all your money into
100%.
stocks or you don't invest all your money into something, but you want to do certain things a certain way, it's okay. Just don't leave your money there in the bank. And that's what I'm trying to drive at is, you're looking at it that, oh, the KYC stuff is kind of redundant, or it's information that doesn't matter. It does matter because that's how you gauge the level of investment for each individual. Some people might fall into high risk, meaning they don't fear at all. Some people medium, they have some little fears, and some people roll, they have a lot of fears. But it's okay. That's all I'm trying to say.
No, I appreciate that. I was just quickly trying to get something from ChatGPT. It didn't really give me anything great, but I simply asked, "Is investing the same as gambling?"
Hmm.
And it said they're similar because both involve risking
I
money
rest my
with the
case.
hoping of. But
I rest my
you didn't even
case.
let me
I
finish.
don't need to let you
You
finish.
didn't even,
I rest my
may
case.
they may seem. Can I finish, please?
Okay,
They
my
may
bad.
seem
My bad.
similar. Both involve risking money with the hope of making more, but they are fundamentally
Mhm.
different in key ways. Fundamentally different in key ways.
Okay.
So, shall I continue? Goal: investing, building wealth over time. Gambling: winning money quickly. That's not what we want.
No, I'm not saying
Strategy:
that's what you want, but
based on analysis, research, planning versus gambling based on chance or luck.
except if you have
I'm
inside
gonna stop
knowledge.
there.
And that's why I threw that in there. Except if you have inside knowledge. And that's why I threw that in there because I
Okay.
knew you were gonna come up with something like that. And I'll tell people, please,
I'm not coming up with it. ChatGPT's coming
but
up with
please,
it.
people, folks who are watching, don't go out there and gamble. It's dangerous. I don't condone it. If you're
Thank
into it,
you.
please don't do it.
I agree.
I was just using it as an example to make an argument. It's not like I condone gambling.
Reckless
Yeah.
example.
Well, I mean, you can call it reckless it's
Let
for
me.
an argument's sake, but yeah, but it's just for the
Yeah.
conversation. But anyways, go ahead.
Last four ones. Risk level can be managed or diversified. That's investing. Typically high and unpredictable. Gambling: high and unpredictable. Time horizon: long term, months to years. Gambling: short term, minutes to hours. Ownership: you own an asset, for example, stocks, crypto. Gambling: no ownership, just a bet. You're just betting on the house. And then expected return: historically positive. Historically positive, my friend. I want to emphasize that historically positive. Everyone that's listening, investing is historically positive. Me and Jai are not saying you're going to win all the time, and it's not about winning or losing. But at the end of the day, you're losing money just by it sitting in the bank. I guarantee you, because of inflation. Gambling: often negative over time.
Of course.
Often
Of
negative.
course.
More often people lose. Like, we should even talk about
Definitely,
it.
yeah.
The amount of lottery winners that have gone back to zero, it's crazy, right?
Yeah.
Anyways, guys, it's been great. Please We want to know what you guys think in the comments. This has been spirited. Thank you, Jai, for taking my crap. Apologies for cutting you off, getting a little bit too heated.
It's
But I
fine.
think we had some great points. I think both of us had some pretty interesting points. Let us know which guy you choose. It's not about choosing really, just whatever you feel is comfortable for you. But just, comments. Like if you guys are like, yeah, I listen to Jai more, I listen to Kev. But just that. But ultimately, this is your own personal decision. It's your life. Always get information. What I like to do is if I'm looking at something that's kind of iffy, I'm not familiar with, I always go online or do my own research. I wait to see what three people say. Three people that I know and trust. If they say the same thing about a type of investing technique, that will prompt me to, either move it closer in that direction. That's a little tidbit, something that I do. Try to get three sources of information where people are doing the same thing consistently. Any real quick things that you have, Jai, in terms of tips to like disseminating knowledge and information with respect to finances
Research.
before we close out?
Yeah, research, research, research. I think that's very key. Don't just
Yeah,
take somebody's opinion or somebody tells you something. You have to research it and make sure that it's as close to fact as possible before you make a decision.
it works for you. You know, I would say one other thing too. I love my little tidbits, so my apologies. But never try to time the market. Just get into the market when you feel right. Never try to beat the system. You're gonna lose out. I have a lot of friends that never bought because 2010, they thought it was a bubble, thought it was gonna burst,
Yeah,
and now they price themselves out of market.
FOMO
They
is a
can't
real
even afford a
thing.
house anymore.
Yeah, FOMO is a real thing. Fear of
Yeah.
missing out. Just
So yeah, so
don't
just
fall
think
victim.
little things like that. Yeah, just always invest and buy when you're ready. When you're ready, don't worry about don't worry about the current market. It is what it is. This is the time you're born. I wish I was born 40 years or 40 I was born 40 years. Like my dad, his first house was $30,000. Like what? But mortgages were also 25%,
True.
right?
It's very
So
true.
it is what it is. All right, guys, we could talk about this forever. We're probably gonna have another session, maybe in a different topic relating to finances. Nerdy Mondays, guys. Hopefully, you guys found it interesting. Please like and subscribe, and we'll see you in the next one. Okay?
Hey
God bless,
guys, God
guys.
bless.
Take
Have a
care.
good one.